So to build on what Richard just went through in the growth recession, had the two negative quarters of the pandemic, but has been consistently rising ever since, and it's 6.2% more GDP now, 3 years later than it was pre-pandemic. Next slide. When you look at the New York Stock Exchange, which Richard was showing you before, if you click one click, it'll show that a 230% increase up to pre-pandemic. And then if you click it again, it'll show a 13% rise to the current growth recession levels of the New York Stock Exchange. Next slide. When you look at commodities, what's interesting is that a lot of the commodities kind of peaked last year in 2022, institutionally and commercially. But as you can see, the lumber is now establishing a new normal. And these new normals are as a result of the changes in the supply chain to meet the demand has been fixed, if you will, and that's what's giving rise to these new normal levels for on the commodity side. Next slide. And if you look at steel, same sort of thing happened pre-pandemic. It was around structural steel, $800 a ton supply, accelerated up in 2022 to almost $1,700 supply, like a doubling in price. But as you can see, the supply chain issues are starting to be resolved on the steel side as well, and it's starting to come down. The lighter red tone is the forecast from the Steel Institute, so it's continuing to edge its way down on the supply side. But that's just the supply, not the fully installed price. Next slide will show you that. So here you can see the $1,500 at $1,488 a ton for the supply side at the bottom of the current bar. And then you add labor and markup and what to gets you to just under $5,800 a ton on a national average across the U.S. Next slide. So getting back to the GDP and the New York Stock Exchange, one of the things that we like to do is when we look at both of these is these are what we call leading indicators of what's continuing to happen to us in construction. And if you look back to the 2008-2009 period, you can see that first of all, the stock market topped first and then bottomed in March of 2009. And then GDP topped second and bottomed in the second quarter of 2009. Whereas the green line, which is our Vermeulens index, which tracks relative pricing for construction, it peaked third and bottomed in 2010. So what you can see is that these two leading indicators of GDP in the New York Stock Exchange give you a year's early warning of what's likely to happen to us in construction. So look at where we are now in construction, and we're having this next growth recession. We've got a growing GDP. We've got starting to have the New York Stock Exchange starting to inch up again, and so the if you look at it as a 1 year look ahead, is the construction prices are going to continue to be trending upwards. So that green line, the Vermeulens index line, will continue to trend upwards. Next slide. This is all of the various Fed indicators that Richard showed you before. And so I'm not going to talk about them in the same detail that Richard did, but I've added a few more data points on here. And for example, you can see in the black line, it's starting to edge up now, which is the New York Stock Exchange. You can see the teal line right below that is continuing to go down from the 9 trillion, getting close to 8 trillion now. The other really important thing here is the purple line, which is the Fed funds rate, the interest rate that Richard was talking about. It is starting to plateau. The Fed held rates back in June. They raised them in July just a quarter point, and they're looking at holding them probably for the rest of the year. So that's good news. The interest rate cycle is about to plateau, or is already plateauing, and it's going to stay there. Some people are looking at it staying there till the end of the year, but possibly starting to go back down again in the first quarter of next year. Because when you look at the red line, the PCE line that Richard showed you, when you add a couple more data points on here, it's already dropped down to 4%. And the expectation as we go through the rest of the year, that it'll drop down to 3% as we go towards the end of the year. And then once it's getting closer to the target of 2%, that's when they'll start lowering interest rates. And some experts are feeling that could happen as early as Q1 2024. All the same time, as Richard pointed out, with unemployment staying at just under 4% at historic lows. Next slide. And the jobs openings is the red line on this chart. And as you can see, it peaked in 2022 up around 12 million job openings. It's now under 10 million job openings. And you compare that to the currently looking for a job, which is the gold line, which is, was at 6 million and now is at 5. So that's the demand for labor that Richard was talking about. It's still strong because job openings are more or less double people looking for a job. And so part of what's keeping the interest rates at this level for the rest of this year will continue that lowering of the job openings to create a new normal on the job side, so that they can start lowering interest rates as early as potentially Q1, 2024. Next slide. And here's the total employment growth right across the entire economy, from the pre-pandemic high to where we are today. It's almost 4 million new jobs have been created through the pandemic. And if we look at the next slide, you can see that form in the far right-hand column is all the new jobs that have been created since the beginning of the pandemic, or just prior to the beginning of the pandemic. So it's 3.9 million total jobs. But when you look at construction is almost 10% of that. So the rate of creating jobs in construction has been twice as fast as the whole economy for 2020, 21, 22. But so far in 2023, the rate of adding new jobs in construction has gone back to the more historic level of 10,000 new jobs every month in construction, which is, so it's starting, the demand for construction has started to abate a little bit. It's still increasing because we're putting 10,000 more construction workers on job sites every month on average in 2023, but that's more than the 20,000 they were putting in before in prior years. So that's good news. It's starting to slow in construction, and what we're looking for is it to slow some more so that the supply side of the construction market can catch up. Next slide. And here's the same graph that Richard showed you, just blown up a little tighter, where we see that for the whole decade leading up to the beginning of the pandemic, the economy was adding 200,000 jobs every month. Through the pandemic, it was 500,000 jobs a month, and in 2023, it's dropped down to back down to the historic 200,000 jobs per month. Next And here you can see that decline in 2023 from, the beginning, it was around 250,000 jobs a month, and it's declined now to just under 200. So that's all good news on the economy, because we need to cut the demand for new jobs, because we are at historic high employment levels. We don't have the labor force. So the raising of interest rates has had the effect of cutting that extra demand for jobs. Next slide. And this is, the slide that Richard showed you, is that the we're not getting anywhere near the recession of job losses that we've had in the past, because job creation on a 6-month average is still over the 200,000 number that was in place for the entire decade leading up to the pandemic. So it's one of, as Richard was saying, it's a growth recession, where the economy continues to grow. We don't have job losses. Next slide. So when you look at construction, here's all those 360,000 new jobs that have been created since the pre-pandemic high. And it's more or less a straight line up, right? And it's starting to slow in the slope from where it was in the last 2 years, like I was saying before, down to about 10,000 jobs per month being added. Next slide. So this is our labor map. This is in the middle of the recession, like all weather maps. Blue is cold and red is hot. So in the middle of the pandemic in June of 2020, there was a lot of contracting construction markets year over year, as measured by the blue. And then when you go to June of 2021, you can see we were, totally bounced back into a normal growing market with a bunch of high growth states in red, and some below average growing states, but still growing in green. Only North Dakota was actually contracting then. Next slide. And then when you go to June of 2022, same thing, very healthy, strong, expanding market with only a handful of states that are contracting. And then you go to June of 2023, and it's the same thing. And what's interesting, and we know this as a country, that states warm up and cool off a little, and warm up and cool off, and this is what this weather map sort of shows, is that different parts of the country experience demand for construction in different points in time. And, for example, now Pennsylvania and Virginia and North Carolina have now moved to below average, whereas Texas is now at average. And Kentucky is high growth. So it varies from month to month, year to year, all around the country as we continue to expand the construction labor market nationally. Next slide. So here's putting the colors on the labor graph for construction, and that we're pretty well in average growth nationally, with hotspots around the country and slightly below average places as well. The net add of jobs is 4.8% of the construction labor force is the expansion from pre-pandemic levels. So next slide. When we look at 4 eastern states, so remember the national average is 4.8% for the entire country. And you look at Massachusetts in the top right, it's at 6.6%. So in that market, the demand for construction is growing a lot faster. So pricing escalation pressures are a lot stronger. If you look at New York to the left, New York still hasn't recovered back to its pre-pandemic highs. It's 3.4% under where it was pre-pandemic. And you look at Georgia, it's the same as Massachusetts, strongly going upward, and Florida is not that far behind. So So 3 of the 4 on here are very strongly expanding states from a construction labor point of view. Next slide. When you go to the other side of the country, and remember nationally it's 4.8%, but Texas is just slightly under that at 3.2%. Illinois is at 2.4%, and California down at 1.4%, and Colorado at 0.9%. So definitely not as strong labor force expansion demand on the center and the west coast of the country. And if you look at Colorado just slightly, it kind of had a peak in 2022 and has sort of dropped down a touch in 2023 as the rate of job creation and construction starts to slow. And what has happened in Colorado is that has meant that in bid coverage on projects has increased, and prices from the subs are getting slightly sharper because it peaked. The number of people on job sites peaked in 2022, and it's slightly less today. Next slide. Now, if you do the same thing on cities, the big major cities in each of those states are showing exactly the same tendency as the state, with the exception of Miami. Miami is starting to roll over the same way we looked at Colorado rolling over. So this may be the beginning of a slightly better pricing portfolio on projects in the greater Miami area. Next slide. And if you look what's happening in the major cities like Dallas and Chicago, they're mimicking what's happening in the state. If you look at LA, it's starting to roll over like Colorado, and Denver is doing the same thing, although it's starting to pick up again in Denver. Next slide. When you look at the U.S. construction volume and divide it between infrastructure, res, and non-res, this is what the charts look like. So it's still, we're putting in more construction than we've ever put in place in our history. And when you look at the next slide, you can see that the residential in the middle peaked last year when the interest rates started to go up, because it's highly interest rate sensitive, namely because of, individuals don't qualify for mortgages, as many of them. And so the amount of residential construction went down. But on the non-res side, so where most of our projects are, it accelerated to more than compensate for the reduction in residential spending. And then the infrastructure bill that just got passed is starting to drive infrastructure spending up as well. So the competition of infrastructure and non-res spending more than balance out the residential slight decline. Next slide. And here's two sectors that make up the two of the 6 or 7 different sectors within non-res. So educational spending, for example, is not too dissimilar from where it was pre-pandemic. It is slightly up, but it's fairly steady spend pattern on the educational side. On the healthcare side, on the other hand, it is dramatically up from pre-pandemic levels, where it was, around 50 billion a year back at the end of 2019, and now it's 60 billion per year now. So it's a dramatic increase. Next slide. So here's the economic indicators and what their status is. So the New York Stock Exchange is 13.2% above the pre-pandemic peak, and it's starting to increase again. GDP growth rate is 6.2% above the pre-pandemic peak, and it continues to increase. So that's that growth recession that Richard was talking about. The Fed funds rate is leveling now at just over 5%, and the anticipation is it could in fact stay level for the entire rest of the year, with a decline expected in Q1 of 2024. Reserve assets, they'll continue to decrease those, which is a tightening of the money supply until they get down to the 5.9 trillion. The personal consumption expenditure is just over 4% now. It's continuing to decline. So the expectation, because there's always a lag between rates and interest rates, and the decline in personal consumption expenditure and consumer price index and whatnot. So the feeling is that the Fed raised the interest rates to the level that they need to continue the decline in the personal consumption expenditure and the consumer price index, and reach their target of 2% by the end of the year. Unemployment rate has been level for quite a while at under 4%, historic lows for the whole economy, and we still keep creating jobs. There's 4 million new jobs since the pre-pandemic levels, and 363,000 of them are in construction. Next slide. So that leads to our forecast. So of course we've got a range. You know, we have the red at the higher end of the range, which corresponds with forecasts for escalation in construction, you know, based on the economic performance. And the soft landing that Richard is talking about is the center one in the blue box there. And the minimal growth is adding 1 million jobs a year in 2024. Currently, right now, in 2023, we're at 2 million jobs a year and 100,000 jobs in construction, or 10,000 jobs more or less. And so the expectation is that by plateauing interest rates at just over 5%, that will continue to reduce the creation of jobs, and we could end up with the minimal growth of until 2024, or we could end up with the soft landing where job creation sort of drops to zero. There's an expectation from some where maybe the Fed is overshot and it might trigger job losses, although that contingent of people is getting smaller and smaller, as Richard had indicated. But we thought we'd put all of the highest probability options here on this slide in the middle in the blue box. So what does that do for construction? So if we're still in a minimal growth type of phase, we're probably still going to need a bidding contingency to address market volatility when projects go out to bid. And it's not nationally across the whole. It's, you know, look at the weather map. What's going on in the city or state where your project is will determine whether you need that bidding contingency or not. And then if you are in this sort of climate, then perhaps the 6% or 0.5% per month type of escalation factor is what you would need. And then the far right-hand column is if your project is starting, you know, at the end of 2026, you know, that's what it could mean in terms of comparison to pricing right now of 29% more. If we hit the soft landing, then we might actually lose a few jobs in construction, which would be actually a very good thing for owners, because that would more or less instantly cause the submarket to switch from saying, well, how am I ever going to get all this work done? Because where do I find the people? They're going to switch to say, hey, I need to build backlog because I want to keep my people. And in which case, then you won't need the bidding contingency, because all the subs will sharpen their pencils, and you would then have perhaps returning to the more historic level of 4% per year escalation in construction. And then if we do happen to hit the minimal recession, which is getting less and less likely as the months go by, we could actually have potentially a flattening of escalation in 2024 as subs hold their pricing in order to secure work. The lower three, mild recession, moderate recession, and deep recession, are more or less off the table. But we have had clients say, well, I think it's going to go, a really bad recession or whatnot. So we've put the forecast of if that happens, but the probability of that happening is so remote. But it's just there for completeness. And the modest growth one at the very top is if we keep adding jobs the way we have been adding jobs so far this year in 2023, if that continues through 2024, then we could be back into higher construction escalation. Again, this one is probably a very remote probability on that one as well. Next slide. So this is in words, kind of what we said. But the volatility remains high because we're at 4.8% above previous all-time highs, and supply chains continue to be stressed. All you have to do is look at how long it takes to get switchgear electrically as a sort of a supreme example of how a stressed supply chain is being impacted by this very all-time high demand for job or for construction. And hence the range of escalation that I just showed you in the previous slide, and the need for bidding contingencies under various scenarios. But as Richard has shown you in my presentation as well, monitoring the feds and what's going on there is the best measure to see what the future holds for us in construction. And because of the volatility, we recommend designing in add and deduct alternates into your construction documents, so that when your CM goes to procurement, you have options as an owner to either buy some add alternates or take some deduct alternates to stay on budget, but don't lose time, because the whole forecast is that there is escalation, and that we so every month that goes by, you're going to have more escalation. In some states less, but it's always going to be some increase in prices. So avoiding a redesign phase by designing in the add alternates into your construction documents is your best protection. And then continue to get your projects shovel ready, again, for the same reason, because escalation keeps on marching down the path. And one last thing, supply chain issues. If you pre-order materials as soon as you sign up the subs, so that you can warehouse it close to site or in their shop, so that you're not waiting for materials. And next slide. So for procurement strategies, we're advocating, and a lot of owners and construction managers are delivering projects this way, where at the time you complete schematic design, you also have a fully complete 100% document package for whatever the enabling projects are going to be. It could be demolition, could be utility relocation, could be digging a huge hole, whatever it is. Design it or schedule it to be procured more or less at the same time the schematic design package for everything else is completed. Then that gives you the whole design development cycle for the enabling to be completed while you complete design development documents. And also you get an early release structure, envelope, MEP equipment, and elevators 100% documented at that time, so that your construction manager can go and procure those. And they're going to procure the MEP equipment direct. They're not going to do it through the MEP subs. They'll get Caterpillar to quote the gear and the generators and whatnot direct to them. Same for air handlers, same for all the major MEP equipment. And then that way you can get into the queue for fabrication early. Then you finish construction documents, and then you're able to go to procurement for all the interiors and MEP trades. And at that point in time, the successful mechanical and electrical subs will get assigned the MEP equipment that the construction manager bought at BD. Next slide.
That's all.
All right. So we're into question and answers now. Well, then we'll end early. Thanks everyone for joining our forum. And if you do have any questions that you would like Richard or I to address, just send them through. So thank you everyone.